Trading Nut Q&A time. We've got Andre Stewart from Chart Artist Trading here on the show to help answer your trading-related questions. So if you've got questions, guys, send them in, and Andre will answer them in future episodes. So today's question comes from Silvestre from Malaysia. So Silvestre asks...
Oh my God, he's in my group, I think.
Is he? Oh, right.
Yeah.
Okay. He asks, how do you protect yourself from surprise events such as the 2015 Euro Swiss franc that resulted in a 2,000 pip gap that caused so many accounts to go negative, and they have to repay their broker because of that event? It may likely happen again, but if it happened, how do you protect yourself from that?
Oh, that's easy. You can't. And well, let me explain. The reason I'm saying you can't is because you can't. Because understand that trading Forex, we are speculators, right? Now, even thinking about what people were calling, quote unquote, the flash crash of this year, where the yen pairs dropped, right? It wasn't even a flash crash. All that did was put in the yearly low, right? And if you're on the right side of price, you got to understand too, like when those sharp, harsh spikes in one direction happen, that is an indicator, right? That's an indicator that, one, your move is about to be over. The market's likely to start to reverse, but you can't. Now, because it's a lot like life, right? You control what you can. You control what you can control, and really, what you can control in trading is your risk parameters, right? So protecting yourself is you have to define your own risk parameters. Like me, like I know for my own trading, my stop is no more than 12 pips. Those are my risk parameters because I'm wrong any time after that. And you have to also be able to define when you should and when you shouldn't be in the market. Like it's different from your actual job, right? Because when you're working, you're supposed to be working and busy on company time. But when you're trading, you're supposed to be waiting and waiting and waiting. And also spikes are predictable, especially where they're going to stop. You just have to look at the charts without bias and understand what key prices are. Because, again, I'll refer to, quote unquote, the flash crash that happened this year. It was simple. It hit a key price. But, again, this may lead into another question, but just you got to transcend the retail mindset. You have to transcend it. And you have to start looking at Forex and stocks and indexes as markets. Not as a technical analysis pool, because good luck with that. And I know that doesn't really answer his question, because I'm literally telling him, well, you can't, because you can't. You can only control what you can control, and that's your risk, right? Know when you're wrong and accept it and move on.
Yeah, so I think so that's probably the best answer you can give. You can't control that. It's one of those things, and I suppose if you're feeling like that's the case, then you might have to withdraw your capital at certain times, or I don't know, trade with less capital. And I'm not too sure. I don't know the answer. I can't give you an answer on that, but I suppose the answer is you can't control it. So, look, Andre, thank you very much for that answer.
Yeah.
We'll get you back on the show for more questions in the future.